So, probably hard to miss the news today. Global markets are seeing some pretty significant turmoil.
Yeah, definitely making headlines. It seems the main trigger, well, it's action from the U.S. side on trade.
Right. Specifically, President Trump rolling out these 104% tariffs on goods coming in from China. That's a huge number.
It really is not just tweaking things. This is a major step up in the whole trade situation.
And the market reaction, well, it's been fast and pretty dramatic, hasn't it? Stocks are tumbling. And maybe the bigger surprise, U.S. Treasury bonds are selling off sharply too. That's not typical.
No, it's not what you'd usually expect. But, everything's so interconnected globally. A move this big from the U.S. economy is bound to cause waves.
Yeah.
The main worry, I think, is that these tariffs could seriously hurt economic growth, raise the possibility of a recession.
Which then brings the Federal Reserve into the picture, potentially.
Exactly. What might they do? Rate cuts become a real discussion point.
Okay, and another thing. Usually when markets get choppy like this, people run to safety, right? The U.S. dollar is often that safe haven.
Typically.
But something feels different this time. Have you noticed that?
Yeah, that's the really interesting part. The dollar, despite its usual safe haven appeal, is actually weakening.
Weakening. So where's the money going?
It looks like investors are moving towards alternatives. Think gold, the Swiss franc. That kind of shift really tells you something about the level of concern specifically about these tariffs and what they might mean for the U.S. economy itself.
Okay, so this 104% figure, it didn't just appear overnight, did it? There's a bit of a backstory to how we got here.
Oh, absolutely. There's been a definite ramp up. Earlier in the year, the U.S. put a 20% tariff on all imports from China.
Right, I remember that.
And then China hit back, put tariffs, I think 10% or 15% on something like $14 billion of U.S. goods.
Okay.
Then came April, and the U.S. added another 34% in duties on Chinese stuff. So 20 plus 34, that got us to 54%.
54%?
Yeah.
And was there talk of de-escalation then?
There was. President Trump hinted he might ease up if China made some significant concessions. So there was maybe a moment there.
A possible off-ramp. But clearly that didn't happen.
Doesn't look like it. Not enough anyway. Because then Beijing announced their own extra 34% tariffs on U.S. imports set to start April 10th.
Tit for tat.
Exactly. And Washington's answer to that was to hike tariffs on Chinese goods by another 50%.
Okay, let me add this up. 20, 34, and now 50.
Yep, that gets you to the 104% total.
Right.
And that latest 50% piece, it kicked in just after midnight today, Washington time.
Wow. That is a very steep climb in a short time. It's hard to see how that wouldn't cause major ripples.
And we're seeing them. The market reaction, as you said, is strong. People are talking about crisis-era volatility. Trillions wiped off market value.
Trillions.
Yeah, look at the S&P 500. Huge swing yesterday. Big drop from the high to the low. They're saying it's one of the biggest single-day reversals in, 50 years.
50 years.
And the total loss in market cap just in the last 4 days. Biggest since the S&P index even started back in the 50s.
Incredible. And the VIX. The fear gauge.
Spiked. Highest since August, I believe. Signals a lot of nervousness out there.
And this isn't just a U.S. story, is it? Europe's feeling it too.
Oh, definitely. The European ZOXX 600 index saw a big drop too. If you look at Europe's market cap loss since early April, when this really started heating up again, it's also in the trillions.
Trillions there too.
And even U.S. stock futures were pointing lower, suggesting this isn't just a one-day blip.
It really feels like investors are just pulling back from U.S. assets, like some economists warned. The whole idea that recession risk should push bond yields down seems totally upside down right now.
Exactly. That typical flight to safety, buying U.S. treasuries when things look shaky, it's just not happening like usual.
So why are yields rising then?
Well, the fear seems to be that these tariffs could actually cause a recession, forcing the Fed to cut rates. So investors are apparently dumping U.S. government debt because of that fear, not buying it.
Dumping treasuries because of recession fears. That's counterintuitive.
It is, but that selling pressure is what's pushing Treasury yields up so sharply. The jump in the 10-year yield just these past few days, it's being called one of the biggest moves we've seen in 25 years.
And there are Treasury auctions coming up too, right? That adds pressure.
Yeah, that's a really key thing to watch. They had a 3-year note sale that was apparently a bit weak. So the upcoming 10-year auction, that'll be a real test of appetite for U.S. debt right now.
Okay, so markets are in turmoil, clearly tied to these tariffs.
Yeah.
What are we hearing from China? How are they responding?
Well, China's sounding pretty resolute. Their embassy in Washington put out a statement basically saying they're ready to defend themselves against what they see as U.S. intimidation tactics.
Intimidation?
Yeah. They say, they don't look for trouble, but they won't shy away from it. The message seems to be trying to bully or blackmail China won't work, and they'll hit back. They called the U.S. tariffs typical protectionism and unilateral intimidation.
Doesn't sound like they're about to cave in anytime soon. So where does that leave us? How long are these 104% tariffs supposed to last?
According to President Trump himself, they stay put until China makes a deal with the U.S. He was quoted saying something like, "Until they make a deal with us, this is what's going to happen."
So indefinitely, unless there's a deal.
He seems to think they will make a deal, saying he believes China really wants one. But for now, the tariffs are on.
Right. He sounds quite firm on that. Now, what about the actual impact on China's economy? Has anyone tried to quantify that? I saw something from Goldman Sachs, maybe?
Yes, Goldman Sachs economists did put out some analysis, and it's quite interesting, actually. They seem to think the hit to China's overall GDP growth will be, relatively limited.
With 104% tariffs.
Their estimate, I believe, was that the first 50% tariff layer might shave off about 1.5 percentage points from China's GDP.
Okay, 1.5 points. That's not nothing.
No, but then for the next 50% layer, they projected an even smaller impact, only about 0.9 percentage points off GDP.
Huh, less than 1% for the second half.
Yeah. So add it up. And while Goldman definitely sees a negative impact, it doesn't look like they're forecasting, a complete derailment of China's growth target for the year, which is around 5%.
That is a pretty notable take from Goldman. Suggests maybe China's economy is less vulnerable to this than maybe the market reaction implies. Or maybe they can offset it somehow.
It's definitely interesting. It suggests that while these tariffs are a huge deal politically and for specific sectors, maybe the direct blow to China's macroeconomy might be somewhat contained, at least in that view.
Still, even if the direct GDP hit isn't catastrophic, according to Goldman, the wider fallout seems undeniable. Global markets, supply chains, just general business uncertainty.
Oh, absolutely. Those broader effects are clearly significant and are feeding into the volatility we're seeing right now. You can't just isolate the direct GDP number.
Well, this is definitely a situation that's still unfolding, something we'll need to keep a very close eye on. It really shows how interconnected everything is, doesn't it? These actions have consequences far beyond just the two countries involved.
Indeed. It seems this standoff, this expensive game of chicken, as one economist called it, it's still very much in play. Neither side looks ready to blink just yet.
Subscribe to our podcast on Spotify, Apple Podcasts, and YouTube. We are here to make things clear. New episodes every day.